Good morning, good afternoon, and good evening. This is Joseph Trevisani from Worldwide Markets. I thank you all for attending. I thank FX Street for providing the facilities and the reputation for all of us to get together. So without further ado, as they say, let us look at today's topic. There's really only one overriding topic in the financial markets, the global financial markets today. This has been true for some time. I would say a year or more. Before that, there were two, although I think the second one is coming back. The second one, of course, being the European financial crisis and the European debt crisis. That has calmed down, but it has not gone away. The ECB has proved that they can prevent a financial meltdown. If there's one thing that any central bank worth its charter can do, and that is to prevent the central bank a meltdown in the financial markets. The traditional and the original role of central banks was to be the lender of last resort, to do exactly that, to prevent a financial meltdown. But right now, and let me read from my introduction here because this is the topic du jour, we have seen very striking gyrations in the markets over the past 2 months, almost entirely based on the utterances of a few central bankers, primarily Ben Bernanke, whose term is up actually in January. So the question is, have the equity and bond markets, which are moving absolutely in reference to what Mr. Bernanke says and what he's expected to do, have the bond and equity markets become mere adjuncts of the Federal Reserve monetary policy? After all, the purpose of the stock market is to distribute capital to successful industries and to take it away from unsuccessful industries and businesses. It hasn't been doing any of that. Let's take a look at what we see in the Dow. Where's the Dow? This is a Dow with reference to QE 3 and 4. The reason I didn't include QE1 in my charts is because the natural snapback from the great crash in the fall of 2008 has as much to do, I believe, with overextended and panic selling and a recovery from that as it does to do with any particular QE policy from the Fed. So this is the Dow. Most of this time, there was very mediocre growth. So just to take a reference and take a look at that, we'll look at GDP. Where's the GDP graph? Hold on, folks. Sometimes my computer slows down. Here, this is the GDP graph we just looked at, right? So there's absolutely nothing to write home about in this particular graph. The average is about 2%. It's probably been declining. Yet, the stock market is at an all-time high. Commodities had been booming. So it does seem, from what we're looking at, and we're going to look at the evidence in particular, that markets are moving in reference to Fed utterances. So let's take a look at this logically. There are two scenarios right here. The topic du jour, the topic today, and also the topic du jour of, let's take a look at a better QE chart here. Let's do something that we all look at for all the time. It's the euro, of course. Back in May 22nd, we need a bit of a narrative for this, so I'm going to provide it. Back in May 22nd, Mr. Bernanke, as a surprise to everyone, mentioned in a speech that it was possible that the Fed would consider ending its quantitative easing program. Now, let me back up then. There are two, when we talk about interest rates in the United States, we have to remember we're talking about two particular rates, only one of which is directly set by the Fed. The one that's directly set by the Fed, of course, is the Fed funds rate. That's been at 0.25% as a reference since for about 4 years, 4.5, 5 years now, if I remember. Let's see if I have that chart here. I'm not sure I brought that one here, the Fed fund. Oh, yes, it is. Fed funds target rate. Okay, since late 2008, so count the years. 1, 2, 3, 4, running on 5 years, 4.5 years. The Fed funds target rate has been at 0.25%. But the target rate influences very little other than what the banks get when they deposit money at the Fed. This is the influential rate. This is the 10-year rate, 10-year U.S. generic rate. And this is the rate which references for many of the market rates. So if this is 3.5, then mortgage rates are 6. If this is 2.5, then mortgage rates are about 4.5%. So this is the rate that matters. So the Fed has direct tools for influencing the Fed funds rate. They set it. When they want to signal something's going on, they change the Fed funds rate. Everyone keys on that. The standard rates in the market are much harder to influence. They do affect and they do key on the Fed cycle. So if the Fed had been looking at this, the Fed funds target rate right here, when the Fed started cutting rates, other rates started to come down as well. But they're not set. They are determined by the market, and they can be affected by factors in the markets. Now, back in 2008, when the world was ending, it didn't, we're all still here, this was going on, but also people were flooding into treasuries because they were terrified, because they thought the world was going to blow up, they were going to lose all their capital, not the return on interest, not the return on debt, but the return of debt. Not the return of principal, on principal, but the return of principal. So the U.S. Treasury rates collapsed as well. Prices went very high because there's a great deal of demand. But, in general, the varieties of interest rates are not specifically set by the Fed. So after, as we can look at in the Fed funds rate again, several years of low interest rates and no appreciable, as far as what was hoped for, improvement in the economy. Let's look at, what do we look at? We'll go back to GDP. Okay. From this period here, we have this very lackluster performance in the economy, despite the fact of very low interest rates. So the Fed, from 2010 on, decided that it wanted to affect interest rates in the broader market. So these are the two sets of rates that the Fed is trying to influence. But it was kind of stuck, because you had you had the Fed funds rate at 0.25% from 2008. It's now 2010, 2 years later. And the 10-year rate is still at 3.5%. Let's say the middle of 2010. Where are the mortgage? Let me just find the 30-year mortgage rate here. Where's the 30-year mortgage rate? Here it is, 30-year mortgage rate. Okay? Back in 2010, as I said, the 10-year rate was about 3.5, so the 30-year mortgage rate was spiking up to over 5%. Mr. Bernanke wanted specifically to affect and help the economy. The mandate of the Fed, not just Bernanke, the whole FOMC. The mandate of the Fed is inflation and unemployment. The economy was not getting that much better. Employment was still poor, very high. So they decided on the historic event or the historic policy of quantitative easing. What was quantitative easing attempting to do? Its purpose was to support the economy. Okay, we know that. But its specific aim was to affect market interest rates, to affect these rates. Just as an example, I've chosen the 30-year mortgage. To bring down the rates in the commercial sector, which were not being affected by the Fed funds rate. So that was the purpose of quantitative easing. Okay, so now, after, what are we in? Almost 3 years in on various, actually if we go back to 2008, we're 5 years in, but let's just say this particular quantitative easing, which was designed for a specific purpose to lower commercial rates. So, where are we with this? You can make a case, but it is the case where you can't prove the opposite. It's the counterfactual case, that without this policy, the economy would be much worse. That's possible, but nobody can prove it. It is the argument that the Fed and the administration, but mostly the Fed, and many economists as well, it's not just the Fed defending itself, have advanced. But it can't be proven. You can certainly prove the fact that it has affected rates. So now that on last May 22nd, Mr. Bernanke brought up the possibility, which always existed, but markets don't care about what exists, they care about what's likely. Everyone knew that quantitative easing would have to end at some point. It can't go on. Eventually, the Fed's going to run out of things to buy. Something like 70% or more of the treasuries issued whenever the Treasury issues them, U.S. government debt are bought by the Fed. If anyone wants to know how this ends, if things don't change, either the economy grows more or we stop issuing so much debt, it ends in Detroit, but that's another topic entirely. So everyone knew, the markets knew that QE could not go on forever. In, I think, that famous line of Ben Stein's, anything that cannot go on forever will not. Well, this is one of those things that cannot go on forever. Regardless of how addicted the markets are, regardless of anything, it can't go on forever. So when Mr. Bernanke brought up this very obvious point and put it in a time frame on May 22nd, markets got very excited. The logic behind his bringing this forward is twofold. Either, and it could be both actually, but either the economy is improving enough, or if you prefer, so much, that quantitative easing is no longer needed. Now this is susceptible to some degree of proof. You simply look at the statistics. If unemployment is better, if various other, and we're going to look at these, you're going to see a reason. You can have the logic. You can say, well, the economy's better. We're going to start ending QE. There's another possibility. The other possibility, and the Fed has mentioned this in their minutes and in other speeches, particularly not Mr. Bernanke particularly, but other members of the FOMC, that QE, which was always a marginal policy to begin with, and I'm going to demonstrate this, it really hasn't done very much to improve the economy, has lost its effectiveness, and in fact is now slipping over into damage. Meaning, the twin Fed policies of low rates, or the single fallacy of low rates, or financial repression as it's called, drives markets to anti-economic, profit-taking, speculative behavior. I don't think there's any doubt about this. I don't think there's any doubt, but it's very difficult to prove. Because if you look, it's almost impossible to prove. If you look at housing, let's take a look at housing prices. So let me just find housing prices here. Where's housing prices? Where are my housing? Sorry, folks. The ability to do this, do I have housing prices? I have housing starts. I had housing prices here. 30-year mortgage. Okay, I don't see housing prices here, unfortunately, unless I put it over here. Hourly earnings, housing starts, jobs. Okay, I don't see housing prices. Okay, this is housing starts. So, as you can see, QE is not the terrible. That's not the point I want to make. So let me just make it. Let me just bring this back here. Okay, this is the oil price. We look at 2008. There's no doubt that was a huge speculative burst in oil prices. Okay, so the effects of QE are not largely economic. They have been largely on the markets. The best example of this is the Dow, and I'll show you right here. Come on, computer. Here we go, Dow. Okay, so the two possibilities here is that the economy is improving so much that we don't need QE anymore. The second is that QE is ineffective and is increasingly ineffective, and in fact, that it is beginning to damage the markets. It's beginning to actually damage the dispersion of capital, where it goes. Instead of forcing it into economically beneficial areas like founding businesses and taking the risks there, the financial repression and the lack of growth force holders of capital to try and earn money in other ways. And that's exactly what's going on here. This is a chart of the Dow with reference to Mr. Bernanke's pronouncements over the past 2 months. May 22nd was the day where he in a speech mentioned the possible tapering of QE. June 19th was the last FOMC meeting where at the end of the meeting, in the Q&A, he seemed to reaffirm that QE was on the way out. Well, look at the reaction in the markets. Through this period here, there were various other FOMC members and Federal Reserve System presidents who were saying various things that this is not going to end, and here he is again right here. This was after July 10th, like 2 weeks ago, after a speech in Cambridge, Massachusetts, I think, to the National Bureau of Economic Research. In the Q&A after the speech, which I believe was after the market closed, he said, no, we're going to keep the policy accommodative forever. It's a debate, or you could say, what does he mean by accommodative? Does he mean that the Fed funds rate is going to stay low for the foreseeable future? Could be. Markets took it, of course, certainly the stock market, as the idea that we're going to keep up with QE and we're not going to taper it. Okay, so those are the two possibilities, and of course, reality is probably somewhere between. The markets are getting somewhat better, the economy is getting somewhat better, and the financial repression damage is also accelerating. So let's look at the first idea, that QE has or has not had an effect on the economy. Whether we see any large evidence of, I'm going to end with the evidence from the consumer economy, from the labor market, but I'm going to start with other ones, okay? First of all, let us look at GDP. We looked at this once, we'll look at it briefly now. It is difficult to see from this chart. This is quarterly year-on rates. In other words, the full year rate of GDP per quarter. It's difficult to see from this chart. This is the period of QE2. Now remember, for most of the time From this period here, there was a lot of QE2, 600 billion. This was QE2, which was 600 billion, 75 a month, if I remember, of MBS paper. Actually, have that here. Hang on. Yes, that's what it is. Permanent low rates, and here's QE3 and 4. When you look at this, and remember, this is for the first quarter. The second quarter, remember, these are cumulative, too. QE started at 45, and the next QE announced in December of that year, last year, was 40, or the other way around. So it's a total of 85 billion per month, which we all know. It is difficult to find any sustained effect from quantitative easing. Again, we're back to the counterfactual proof. It would have been worse without it. That's probably true to some degree. But in a policy which is only marginally effective and has definite dangers attached to it, one must have to make a judgment. So on this chart, when we look at GDP, it does not seem that there's any sustained positive effect other than that it would have been worse. You're not seeing 4% growth. I know we've heard this all many times, that the deeper the recession, the sharper and more pronounced the recovery. That certainly has not been the case this time. So that was Jill. Let's look at the Fed national activity. This is a similar ISM number from the Chicago Fed. Tracks business activity across the country, not locally. Again, the same item. With or QE, without QE, there does not seem to be any pronounced trend in the markets, in businesses, related to or not related to QE. We're back to the same point. Oh, great. Yeah, I forgot to mention that. I'm going to get to that. I'll be glad to answer all questions in between. I actually love doing that. I like it to be more of a colloquium, if you will, than a lecture. But there's been no sustained, according on this chart, no sustained effect from QE. So let's look at some of these questions. Yes, I'm going to play that out in exactly the same place. I don't believe that Larry Summers is going to get the job. I don't know who's pushing him, but I don't believe it for a minute. As far as Janet Yellen, I'm going to get to that. And part of this whole topic, I think, on the end of QE has to do with the replacement of Mr. Bernanke, who's basically been told by Obama, you're not getting reappointed. Okay, so we don't have anything there. Let's take a look at housing starts. Now, housing starts has more of an effect if you're looking for an improvement, but there could be many other reasons for this as well. In fact, yes, it has improved from the lows down here, which are historical lows. These are housing starts. But the average, if I remember, over the past 30 years is around 1.3 million new houses started per year on an average rate. Now, 30 years ago, the population in the United States was 40 million people. I forget the exact number, less. And look at this fall off here. This is QE 3 and 4. Again, there isn't any evidence here that quantitative easing policies have supported a expansion into the economy. Look at retail sales. These charts are all starting to look familiar, aren't they? Same thing. Now remember, retail sales include inflation. They're not adjusted for prices. So the actual growth is about a little bit less. This is headline number, a little bit less than 2% less than this. So maybe very mediocre growth. Again, no sustained effect. In fact, if you look at this, and you look at some of the other charts, there appears to be a drag on the economy. It's not even maintaining. It's slipping. Retail sales, housing. Okay, now let's look at some of the actual one more. Wait, we'll look at one more. Okay, also it's true there's no inflation. Everybody agrees with that? Dun, 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 we know that. Remember, the Fed's target for inflation is 2%, both from up and down. I know from a consumer point of view, that seems bizarre. Why would you want more inflation? But in fact, you can tie inflation, theoretically at least, and on economic theory, to expansion of credit and how that's necessary for economic growth. But that's another point. That's a modern phenomenon that, one, I'm probably as not an academic economist fully qualified to deal with, but it's also another topic. So, this is inflation. As you can see, QE, and Mr. Bernanke has been dead right on this from the very beginning when QE started and they were screaming and yelling and gold was soaring. Inflation is right around the corner. We're going to go back to Weimar Germany. Mr. Bernanke is absolutely right about that. No demand, no inflation. Low demand, low inflation. You can create as much money as you want. Nothing's going to happen. And this is what's going on with all the money creation that the Fed is doing. It's sitting on deposit at the Fed. Banks aren't lending, not because they don't want to. It's because there's much demand. So, there has been no inflation. Mr. Bernanke's right about that. We looked at QE. Let's look at manufacturing ISM. Looks a lot like the Chicago National Activity Index. There isn't any evidence that quantitative easing has boosted the economy substantially. It certainly has not done what they had hoped it would do, and that is create a self-sustaining recovery. This is not a self-sustaining recovery. Manufacturing is used as a leading indicator, even though the U.S. economy is somewhere south of 15% composed of manufacturing firms. I tell you, I've been doing a lot of work around our house, and it's difficult to find a power tool made in the United States anymore. It's very difficult. Okay, now retail sales. We looked at PC Core. Now let's look at some of the specific consumer-based, not consumer-based really, but labor force numbers. Okay? Let's start with the unemployment rate. This is probably the best looking chart from a point of view for QE reference. If you're looking for something that says, wow, QE is actually working, this is probably the best chart. On the face of it. Okay? Because QE starts, we have a nice downward slope in the U3 rate. That's the rate you always hear about, the 7.6 rate. Okay, this is the U6 rate, also called the unemployment rate. Also going down, but not quite as impressive. Now the question is, of course, why is it going down? So, at least for the U6, the U3 rate, this is the reason. This is labor force participation. The U3 rate, the headline rate, the 7.6 current rate, is not going down primarily 70%, 60%, because people are finding jobs. As we all know, we've read it. I'll explain that in a second. U3 and U6. There are two different rates out of the Bureau of Labor Statistics. The U3 rate, that's the headline rate, the 7.6 rate. What that rate is, the government counts unemployment. They don't count you as unemployed unless you have, under that rate, the criteria for assembling that rate, unless you have looked for a job actively sometime, I think in the past month. If you stop looking for a job, and they do this on surveys, they ask, if you stop looking for a job, they don't count you as unemployed anymore. That's what the U3 rate is. The U6 rate both counts people who look, I think the time frame for having looked for a job is much greater. And it also counts people who are part-time employed and want to be full-time. That's this rate. The U6 rate. And as you can see, the difference is enormous. It's almost double. This is almost 14.5% people do not have either a job or a job that they want because they're not making enough money. They're only working part-time. That is the more accurate portrayal of what's actually going on in the economy. I mean, I go up and down Broadway in New York, where I live in Manhattan, And I see empty stores, and I've seen them for 4 years now. Stores that have been empty for 4 years. This is not a booming economy. The unemployment rate, which is always quoted, which is this one, the U3 rate, has largely come down because of this. People have simply dropped out of the market and stopped looking for jobs. This is a historical, this mark right here, it's 63.3, is a historical low for labor force participation in the United States. This is the reason both unemployment rates have come off. It is not because people have found jobs. So again, if you're looking at QE as a successful policy, once again, we're back to the counterfactual. Well, it would have been worse. If the unemployment rate was where about 66%, where it was when there was beginning of 2008, the unemployment rate in the United States would be about 10%. I think that's what the calculation is. Now, there is one caveat to this. The baby boom generation is retiring, so there is some natural fall off in the participation rate. Even accounting for that, the unemployment rate would probably be well north of 9%. This is a more accurate portrayal of what's going on. So again, we're looking at QE. We don't see anything here. Let's look at other items. This is the household jobs survey. These are people who work at home. These are jobs which are not usually counted. There are two surveys. There's the establishment survey, which produces the unemployment rate that you're used to, the U6 and the U3 rates. And they poll established companies. They say you're hiring, you're not hiring. But there are many other ways of working, and they are counted in this survey here. Again, we're back to the same topic. I'm just trying to broaden the view of the economy. Again, there is no concerted evidence that quantitative easing as a policy has provided a sustained boost to the economy. Average hourly earnings. This is even grimmer. Look at this one. Remember, inflation is running about 1.5%, between headline inflation between 1.5% and 2%. This is the improvement in the money that people actually take home. These are grim numbers. Grim numbers. There's essentially no growth from 2009 until now in the purchasing power of the American consumer. Let's be generous and say the average from late 2009 until now is 2% growth. Average hourly earnings, all employees, Bureau of Labor Statistics. Well, inflation is 2%. That means no one, the economy, the consumer, the 70% of the U.S. economy supported by consumer purchases has seen no growth in their purchasing power. They have started to expand their debt again. So again, if we look at this, there's very little proof. Really very little indication, come on computer, that the quantitative easing policy has improved the economy. Let's not say improved the economy, because the economy has improved. There's no doubt about that. Has provided the boost, the catalyst to a sustaining recovery. This is consumer. Now, I put this in there because we're all consumers, at least here in the United States. I suppose in many other places around the world as well. This consumer confidence in the University of Michigan. There are two numbers which come out in the U.S. One is from the University of Michigan. I think Reuters and Thomson's. Reuters is involved in that too. They are. And the Conference Board, which is a business group. The University of Michigan survey is usually more optimistic for whatever reason. It has to do with their methods, I suppose, the questions they ask. Again, you could say that from here on in, QE3 and 4, last year and this year, consumer attitudes are improving. And I think they have. But the way this is amassed, a lot of things are included in this, one of which are levels of the stock market. And since the stocks have been happy with QE, that gets factored in. So these numbers are not that reliable as far as economic indicators go. Okay, so those are some of the statistics from the economy that don't seem to show any sustained improvement from quantitative easing. So let's look at the other side. Let's look at the market side and see what effect the quantitative easing policies have had on that. This starts out home prices. This is Case-Shiller. Now looking at this, you could say that there is some effect on the home prices. At least in the latter part of 2012, you see a sustained rise in U.S. home prices. In fact, the Case-Shiller index has got, the last one, as you see there, was a 12.5% annualized increase. A couple of years of that, and where are you? You're back in bubble territory. But one of the reasons why you're seeing this home rise is this. It's housing starts. There haven't been any. The other reason is that in many markets, especially the ones which were badly hit in the financial crash, there was a huge glut. But at some point, again, because of financial repression, because it's difficult for hedge funds and other people who's paid to earn money from money, to earn returns, they started chasing housing. There are lots of stories about a year and a half or 2 years ago of, guys in suits showing up on building lots where there are half-finished or full houses unoccupied for 3 or 4 years and buying up en masse for cash. Nobody who is permanently, or very, very few people in the United States who plan on living in a house buy it for cash. They buy it on a mortgage. If you're buying for cash, you're probably an investor. So the housing prices, remember what I said earlier, this rate, even here at 1,000, and now look how much we've dropped just recently. But the average here, I don't know, is somewhere around 700. That is half the historical 30-year average of housing starts. And that 30-year average has a population much lower than it is now. So the Case-Shiller home prices have a lot to do with inventory and with investment. Let's look at the one we always deal with. Let's look at euro. Okay, this is the 3-year euro. It doesn't seem that there's a whole lot of effect on, and I could have chosen the dollar index here. There's a more pronounced probably effect. There's a more pronounced effect in the dollar index. But right here, if we're looking at this, there isn't a whole lot of effect on QE. Right around here, there has been. Now, there's a good reason for this, of course. QE, as a policy, did, when it was first announced, have its effect on the euro, but it was quickly trumped by the European debt crisis and all the gyrations that have been going on there for now 3 years. Remember, the debt crisis started with the announcement by the Greeks, the new government of Papandreou, in December 2009, that the Greeks had made a mistake with their debt. And then in January of 2010, this is how long it's been going on, that their budget deficit for the prior year was actually 12.7% and not 3.7%. It took them a couple of weeks to get to that actual number. So that's the inception. That's the public acknowledgement of the European debt crisis. And that accounts for a lot of the movement in the euro across this time period rather than any direct relation to QE. But let's look at a more specific chart, okay? This is a recent chart, the past 6 months, where we now have the European debt crisis in abeyance for the time being, not really affecting the markets. Now we see pronounced effects from Fed announcements on trading rates. And this is what we're looking at. These are the market effects of QE that we're seeing now. So, May 22nd, Mr. Bernanke brings up the possible end of QE, and what does the euro do? Goes up. Which is, if you consider it, an interesting effect, because you would expect it to do the opposite. But at the time, markets were not taking a particular amount of attention to that, at least the currency markets. June 19th, suddenly they get there. And we all know currency markets can be very oblivious to what's going on. They were in this case, but then they stopped being. June 19th is when, after the FOMC meeting, the Fed, Mr. Bernanke seemed to repeat the idea that QE was going to be tapered out, and we got a pronounced effect from 34 to below 28. So there's a pronounced effect. At this point, the currency markets are clearly paying attention. July 10th, after the speech for the NBER, Mr. Bernanke says, nope, we're not going to end QE. He doesn't actually say it. He says we're going to remain accommodative. Again, looks to me like he's referencing Fed funds, not QE. Euro goes back the other way. So this is a pronounced market effect. Let's look at the Dow. We look at this one. This is the larger QE effect, but this is a specific Bernanke reset. And this is where I think the Fed's focus has turned to the effect on the markets of their policies and their specific endings. So look at this. May 22nd, we do get a gradual fall. June 19th, remember, that particular FOMC, and you can see the effect. Okay? Wham! And then creeps back up July 10th. Now, this particular July 10th was when he said, no, we're not going to end QE. It was after the market closed, so you got the big effect the next day. So, the financial effects in the markets are pronounced. Let's take a look at some other markets here. The 30-year mortgage we looked at. This is one of my favorites. So, and this gives us to the next idea in this particular discussion. The Fed's problem, basically. So, 10-year rates, May 22nd, we're going to end. Rates go up. Come off a little bit. Okay, remember, rates have gone up. This is the bond. Sorry. These are actually this works as well. So this is the bond market. This is the mortgage rates. You can see the pronounced effect of what the Fed's been doing. These two shoot straight up, especially after the 19th. We go from 4 to 4.5% in a matter of days. These are huge moves for credit markets. The 10th, the Fed, nope, we go back down to 4.3. Okay, that's good. Let's take a look at where's the 10-year? Here's the 10-year with the end dates. I love these charts. These charts are all Bloomberg, by the way. May 22nd. Now, remember, back the beginning of May, the 10-year, which is the benchmark that everyone talks about, was 1.63. In a little over 8 weeks, it went to 2.74, which is right here. These are enormous moves for the bond markets. I forget who said it, but somebody said, when I come back, I want to come back as the bond market. The credit markets are forced by the nature of their instruments to take the longest and most practical view. Because bond instruments run 5, 10, 20 years. Bond markets, and actually all trading markets, move at a rush. So if everyone thinks that we have reached a turning point on the rate cycle, then he who jumps first makes the most money. And you see that very much in this adjustment. So the 22nd, the 19th, look at this rise here. From 2.2 all the way up. Here's some profit taking, it goes back up. July 10th, we've seen the rise back down. So the financial markets, again, are paying extreme attention to what's going on here. Let's take a look at oil. Oil. We're all paying here $3.50, $3.75 for oil. In California, they're paying more. New York, it's high. Jersey, a little bit lower, have to do with taxes. Someone tell me that there's no effect from oil prices. I mean, from the dollar and what Bernanke is saying on oil. Remember what's going on in the world around us. U.S. second quarter growth is probably going to be around 1%. Europe's in recession. China is slowing dramatically. They say 7%. Nobody believes those figures. Yet, oil is above $100 at $107. Why? There was the CO2 report from the Board of Trade in Chicago. The latest number had a big rise in the number of outstanding long contracts in oil. What does that mean? It means that people are playing, probably hedge funds and others, in the oil market. Remember, there's an unlimited number of contracts that can be bought. All you need is somebody to sell. You don't need an attachment to the oil market, the physical market. So it's no doubt, in my mind, that again we have the same issue here. The dollar weakens. That's what's been going on here, especially since the 19th. Right around here. The dollar weakens. Oil prices go up. So there's also been an effect there. Okay, so those are the two sides. Let me answer these questions. Those are the two sides, and then we're going to look at the Fed's dilemma, and then we're going to end up. Okay, so let me just answer these questions. The U.S. banned Iranian oil. Yeah, but the oil market's completely fungible, so it doesn't matter a whole lot. You'd have to have a much greater portion of the oil ban, successfully ban Iranian oil for it to have an effect, because if it doesn't go here, it just goes to China, and then we buy oil from someplace else. So there isn't a whole lot of effect. Okay, so we have the evidence on both sides. Certainly, QE has had a pronounced effect on the financial markets. It does not seem to have had a very powerful effect on the economy. So here we are. We have a policy which seems to be creating volatility, danger, and speculation, also financial repression, moving assets from productive ends to trading ends. So what do? So the Fed announces that they may perhaps, let's take a look, let's put up a chart here so we have something to look at. Look at the 10-year, my favorite. So the Fed now has a dilemma. And remember, the notes and the minutes are edited, the FOMC minutes. So if they stick in there discussion about the problems and the dangers of QE, it's deliberate. When Mr. Bernanke gets up on the 22nd and says, oh, you know what, we may start tapering QE, this is not because he didn't get enough sleep the night before. Or his child called up and said, it's not thoughtless. It's totally and completely deliberate. Mr. Bernanke has very much brought in a much more transparent, although in situations like this it's difficult to be transparent. He now, I think, appreciates that. There are dangers in transparency as well as benefits. A much more transparent policy. So he's very much about telling the markets what he's going to do. And that was the reason the problems of QE started showing up in the minutes. That's the reason he said what he did on the 22nd. That's the reason he said what he did on the 19th. The problem with the Fed is, if the FOMC and Bernanke believe that QE is running out of its time frame, that it is no longer providing what was really just a marginal support to the economy originally, that the balance is now shifting to danger, to perhaps bubbles, which are very difficult to determine and very difficult and dangerous to prick, that it's run out of its time frame. Their problem is that they need an economic logic, a positive economic logic for ending it. They cannot come out and say, QE hasn't really done very much, and it's now creating more danger, so we're going to end it. They can't say that, because that would absolutely tank the markets. Everyone would panic. They can't say that. So they have to have a positive economic logic for ending QE. The only possible choice is that the economy is getting better, which is debatable, to say the least. Or at least the degree to which it's improving is debatable. But the problem for the Fed is that as they intimate the end of QE, rates rise. And this is why you've had this very puzzling, it seems, reaction from the Fed. The Fed comes out and says, deliberately, we're thinking of ending QE this year or next year, probably starting this year. Rates skyrocket. Okay, the Fed knows rates have to go up, and they know it's going to be a violent move. But if rates go too high, and markets always overshoot, it could very well, and most likely will, damage the statistics that are coming out, undermining the economic rationale for ending QE. So the Fed has to go back, which it deliberately did, and walked back some of their QE tapering talk. And the reason is this chart right here. The rise that began was threatening to keep going. And if you start getting the 10-year above 3%, which is where it's historically going to go and is going to go there, then you start talking all of the collateral damage in the economy from higher rates. So the Fed had to walk it back. It doesn't mean that they've changed their policy. It doesn't mean, in my mind, that they're not going to end QE. And I think the greatest proof we have of that is this chart. Let me get a more, I should have put up a longer chart so that you have a better idea of the historical levels of, let's use the long-term chart, right here. Okay? The historical levels of this 10-year rate are up around 3.5%, 4%, 4.5%, much higher. That's where this is going to go. In my mind, the proof that the most accurate reflection of Fed policy is in the bond market. You know, when I come back, I want to come back as the bond market. I think that was Clinton who said that. And what you see here is that the bond market believes, despite the rhetorical walkback, that QE is going to go. It's going to end. And the reason is because the rates have not gone back. You've got this huge rise from 1.63 to 2.74, and we're now sitting, when I made this chart, which was about an hour ago, 2.57? No, that can't be where it is. That's where my marker was. It's about 2.51, I think, or 2.52. So that's where my marker was. The point is that the rates have not gone back down. They paused, and that's exactly the effect that Bernanke and the FOMC wanted. They wanted to, right here, as rates were shooting higher, they wanted to stop the rate increase because that could very well damage. Yes, I'm actually on time with this for ending. I'm actually at the end of my summary here. So let me just finish briefly talking one more topic, and then I'll answer the questions. This was exactly the Fed policy. So this tells me that QE is out. Maybe not September, because we're going to get GDP before then, and GDP is going to be poor. It's going to be around 1%. But QE is on the way out. That's what the bond market is saying here. The fact that Bernanke, and there's been a lot of confusion about this, and I think it's taken some time for people in the bond market and traders to realize what's going on, to do the full analysis about what's going on here that I presented here. But the greatest proof it is right here. Okay, so the last topic is Mr. Bernanke is a historical figure. He operates on a different plane than you and I. That is true. Quantitative easing will forever be associated with his chairmanship of the Fed. His term is up at the end of January. The administration, I feel sure, in lieu of the 2014 elections, will appoint, and of their own economic philosophy, and I must say this, well, I'm not going to say it, will appoint an easy money chairman. It's very evident, at least to me, and I'm assuming Mr. Bernanke and the other hawks on the board, that if they do not get an end to the QE policy in place before he's out, then the next chairman will run that pump at full speed. I think that's their fear. Because if you look at the economy, there isn't enough strength to make a good case that QE is not useful. Even though it hasn't had any effect, the negative effect to the markets from withdrawing it are what we're talking about, not the positive effect, the ending the addiction. That's the last reason I think that they're involved in this. Now, let me answer some of these questions here. So, yes, I think that you will get rises, not so much in other economies, but certainly in the United States. I mean, if there's a world central bank, it's the Fed. And the effect of QE policies definitely has an effect on other currencies and other economies. You can look at emerging market currencies. They're tied very closely to what's going on here. And one of the reasons are because that money, hot money running around the world, goes to emerging economies. When it becomes evident, right now the markets are on the idea that the Fed, the currency markets, remember the currency markets have paid more attention to the walkback of the end of QE than the bond market has. The bond market is right. The bond market has a much longer view. So when it becomes evident towards the end of the summer, I think, the Fed's not going to say anything right now, but as it becomes evident, the currency markets are going to need concrete proof, shall we say, that the QE policies will end. At that point, the dollar strengthens dramatically. I still think the dollar ends up much stronger than where it is now at the end of the year. I've been saying this all year since the very beginning of the year. My original target was 1.2. I'd probably stay with that, maybe a little bit higher, 1.25, but I do think that the dollar will strengthen once this becomes more evident. Once the fact that the bond market's judgment is that QE is on the way out. Whatever the timing is, and I think we're going to get a pause here, you're not going to see it shooting up right now, but whatever the pause is, the quantitative easing policy is going to end. And when we see the proof of that from the Fed, you'll get the turnaround. Yes, I'm not sure. I think probably Janet Yellen. I mean, I'm making my judgments based purely on electoral politics. One, she's a big dove, and two, she's a woman. And I think the administration would like to do everything it can to ensure the female vote in the 2014 elections. So, I mean, there's only upside for the administration from putting a dove in they're not going to put in Larry Summers. I mean, I just don't see it. I've read a number of articles lately that the Senate, which is, possibly could go Republican, is the Democrats will depend very much on the female vote. Well, they're not going to put in Larry Summers because the Republicans are going to, you're going to get lots of stories about what he said at Harvard, which in fact was completely untrue the way it was portrayed, nevertheless, it can easily be used against them. So I don't see large summits at all for those reasons. They don't end QE. Will they allow rates to rise next year too? No. I think that they will, and no, I don't think so. Certainly, if they don't end QE, they're not going to raise rates. But I think what Bernanke said is accurate, that the Fed funds rate will probably stay low for a long time. The Fed funds rate doesn't matter that much. It's the market rates that key on the 10-year here and are determined by market factors that matter. Okay, folks, I thank you very much for your attendance. It's always a pleasure and an honor to see people who show up and take the time to listen. I thank you all very much. Again, I thank FX Street for your facilities. And I hope to see you all again next month. We will give, certainly on my website, the Worldwide Markets website, we'll give more notice about this so that you can all sign up again. I haven't decided. I'm going to actually be on vacation for a good portion of August, so we'll probably only be able to do one webinar in August, and then we will resume the usual schedule in September. Again, I thank you all very much. I will put my email up there so that if anyone has any questions or comments or anything else, please send them to me. Thank you very much, and everyone have a good day.